All right, good morning and welcome to Paradigm Legacy Planners 2023 Taxes and Tax Strategies webinar for next year. I am your host, Tom Vick. I'm one of the co-founders of Paradigm Legacy Planners with my wife, Abby Vick. I have extensive background in this business. Folks have been financial planners for 25, 30 years. I grew up in the business, and now we have our own practice here in Arizona. From Chicago, so I am from the Midwest, like many of you probably watching this webinar. And it's good to have you on with us today. Wanted to give you a little bit of background about our firm. We're a registered investment advisory firm. That means we're independent. We can offer all different types of planning strategies. We can talk about taxes, which is one of the most important requirements, I think, for when you are a pre-retiree or retiree, and you have to be more mindful about your taxes in retirement. You want to work with a firm that can actually legally provide you some tax planning advice when it comes to your investments or your income strategies in retirement, right? A lot of other of the big box firms out there can actually provide this advice. If you look up in their disclosures, you're going to see that they can actually provide you with tax advice on anything. They could just hand you the form for doing a Roth conversion, which I've experienced so many times working with new prospective investors at Paradigm, where they were just simply given a form and said, hey, figure out the calculations on your own. Not that you should or shouldn't, right? It's about what's in your best interest. And that's what Paradigm is all about when it comes to taxes. And so this time of year, it's all about tax planning. It's all about looking at this year's income, your investments, where you're at in real estate or other diversified investments, and figuring out how can I make some tax moves right now to benefit myself, 30, 40 years into the future for not only for me, but also for the legacy, your estate plan that you're going to leave to your kids and that kind of a thing. So I'm going to start with this simple illustration for you. Imagine today that you're retired, and congratulations, you're looking for your perfect age in place home, and that home has to be just right? It's got to feel like home to you. And you call up your realtor, and he has a couple of portal links for you to go look at, and you tell him, hey, I want a house with a good access to excellent communities. It has to have a great proximity to family and friends, right? Want to be close to those people that you love in your life. And then plenty of space for a garden and grandkids, and maybe some room for the pet. I don't know. And so your realtor tells you that there's a housing shortage and you need to move fast in order to make this house purchase work out for you this year. So you drive around, you go through the portal, and you figure out two houses that you love, and you just love them. But both houses look so dang similar. Both choices are very similar, right? And so what do? You sit down with your cup of coffee, right? And you are doing the Benjamin Franklin T chart about the pros and cons of this big life decision of downsizing this home that you've lived in for many years, and you want to get a smaller house so you can maintain it, and you just can't decide. And so you kind of flip a coin, and you decide that you want the house on the left because it maybe reminds you of a home that you had maybe in the Midwest. I don't know. And so you get that home, put in an offer, and it goes through, and you're just pleased as punch that you got this beautiful house, and you're renovating things. You put a little bit of money into it to make it feel nice. And then a few months later, you're checking your mail, and you get a letter, and it says that the county is going to raise taxes on you for being close to the new highway or light rail. And you're thinking that through, and you're going, wow, why are they doing that to me? And if you remember, this has actually happened before in the state of Arizona, where if you remember the 101, when that went in, and we give this illustration in the workshop all the time, the 101 went in, and people got that first letter that, hey, we're raising taxes on you. And then secondly, we're going to have to put your home in eminent domain authority, meaning they're going to buy your property from you so they can build an infrastructure on that property. And now what do? You've got to go back and get a new house, right? So you go back, you get fair market value on this home, call up your realtor, you ask him, hey, is the house on the right still available at second house? And what are they going to say? Well, no, it's gone. It moved last month. So now what do you do? And so my question is, what's my point? You want to know the critical facts regarding your house purchase before you make your house purchase, right? If you could know that your home at the 101, before it was the 101, was going to be put in an eminent domain authority, you want to know that, right? Prior to doing this? Of course you would. Of course you would. So when you're going to make a sound planning decision, it's really important that you get the critical facts to making that sound planning decision. And when we say critical here at Paradigm, we mean that, if it's something that you need to be made aware of before you ever make that significantly big decision, right? Like converting to Roth or buying a life insurance policy or creating an estate plan or setting up a CRT. You want to have all the critical facts in place. You want to know how everything works, how much it's going to cost you and what's it going to save you and all those things. You want to know the critical facts before you make that move, right? And then you want to make a sound planning decision here when it comes to your taxes at the end of the year. There's two parts to making a sound planning decision. First, you got to understand the critical components associated with the needs and goals you are looking to accomplish. When we talk about taxes in this webinar today, I want you to be thinking about how do some of these strategies help me accomplish some of my goals, my lifestyle? Where do I want to go in retirement? Where do I want to go in life, right? We want to help you understand, does any of this make sense to use for you and your retirement lifestyle, right? And secondly, you need a clear understanding of how each decision you'll make will affect all the other decisions in your planning process, right? There's no going backwards on some of these things that you do in tax planning. And so you have to be very careful. You have to do the math. You have to base everything that you do in math and science. When we do Roth conversions or when we're working with tax-free accounts or we're structuring a trust, you have to make sure that the laws match up with what you want to do and you understand them and that the math adds out. What's the time value of doing a Roth conversion? Is it in my best interest to really put this together for me as an investor? And so through the webinar today, you're going to discover some critical facts. There's about 6 different strategies that we're going to show you today in the webinar. And you want to think about these critical facts in a framework to making a sound planning decision. I'm going to give you that framework right now. Most people just don't have a process when it comes to this. They feel overwhelmed at the end of the year. A lot of things are happening right now. You got the election that just happened and all the craziness that came with it. You're seeing, crypto exchanges go bankrupt. You're seeing a lot of, family right now. You're going through a lot of, family dinners and maybe lots of holidays. We had like 5 birthdays this month alone. And so you got a lot of things happening right now. And to look at your taxes might feel overwhelming to you. But if you work through it in a process and just take things one step at a time, the right process, you'll find yourself making a decision and saving a lot of money in the future, in the long run. And then you want to have a process. Most people don't have a process. So they just stay overwhelmed and they don't make a decision. Secondly, there have to be the right questions to ask. What are the right questions when it comes to tax forward planning? We're going to get to some of those today. And then you have to have a checklist. There's a bunch of items to check off when you're creating a tax forward plan. When you're looking at the liability of taxes that is going to go up in the future in 2025, that's very soon, that we are going to go back to 2008 tax rates. And so you want to make sure that each account that you've got to understand the rules that you're playing by in those accounts. Understand that the taxes, how things are taxed in those accounts, right? You have to apply these things to the critical facts that you're going to learn today, and that's going to help you make a sound planning decision. All right, let's get into today's content. So what kind of an investor are you? There's 3 different kinds of investors that are probably on this phone call today. Number 1, the underfunded investor is someone who's probably $500,000 and less in assets, and you're using every single one of these dollars to make sure that you stay retired or that you're protected and that you have enough income coming in from Social Security, or maybe you got a pension and you have a nice investment account that's giving you income, and you structure that in a way to actually last the rest of your life. There's a few ways you can actually use basic tax knowledge in the code to help you save money each year. And we'll show you some of those strategies. Constrained investors, that's the second type. We just talked about underfunded. The second type is constrained. Constrained investors are between 500,000 up to $2 million. They're constrained. They have lots of decisions to make when it comes to their money. They have enough money to probably last on in retirement if things go right. If things go all right in the market, you'll be okay. If we use average rate of return at 5%, you'll be okay. But we know that average rate of return actually doesn't work out. You can check out one of our other workshops where we break down that math for you. And so you have that market volatility is kind of a big worry to some of those investors who are a little bit more risk adverse. If you're a little bit more aggressive, taxes is going to be a bigger worry for you, and how much you're getting taxed, whether that's income tax or capital gains tax on your investment income that you're deriving out from the portfolio to live on. And then third, we just talked about constrained investors. We talked about underfunded investors. And thirdly, there's the overfunded investor for retirement. You're overfunded for retirement. You've got enough money. You're okay. You're $2 million up past that point. And you have a lot more flexibility in your life. Maybe you're considering giving away to charity. Maybe you're considering going on some bigger trips, or maybe you're looking at investing in different businesses and ventures and things like that, being a mentor in maybe your industry or what have you. And so you have a lot of options, but you might not know quite how to save on taxes as that type of investor, and the many different accounts and strategies that you can be using to possibly eliminate your taxes altogether, or at least reduce your taxes so that you're keeping more of your income, 7+ years into the future of your retirement. So here's our objectives today. Some of the right questions to be asking. What taxes will I have in retirement? We're going to talk to you about that. How to strategically reduce or eliminate your retirement taxes. Yeah. Is the Roth conversion still a good play? We're going to show you that it very well is a good play to be considering still for 2023. Can you use estate plan to reduce capital gains taxes? There's actually a way you can use different trusts to help you out with your non-qualified accounts, and also help you out with Roth conversions, which I'll explain a little bit later. And then how can you build a tax-efficient, forward-looking plan to achieve financial stability no matter what tax climate we are in, right? You want to have a portfolio that is diversified in the many different taxable and non-taxable accounts that you have. And if you're all in one account, you might be paying a giant tax bill that you didn't think that you would be paying in the future. And so it's really important to come in, get a tax analysis, which we're offering that on the phone call today. If you want to do so, it's an hour of our time. It's completely free of charge. And it's simply an analysis of, as your portfolio stands today and how things are structured with the different investment vehicles that you possibly have, how will your taxes have to be paid? Where are you being taxed? Where are you in business with the IRS in that portfolio? We'll be able to show you that in the analysis, and maybe hypothecate some different strategies for you to use to help you eliminate or reduce taxes. So what are the kinds of taxes? So you have income taxes and capital gains taxes. Income tax is derived from the items on the left there, RMDs. That's your required minimum distributions. It's a big thing to be thinking about when you are constrained or underfunded as an investor. The RMDs that you're going to have to be mandated to pull out of your retirement accounts at 72, you'll have to pay income tax on those. There's interest, there's dividends. Social Security is taxed. It is looking to be taxed higher in the future. Right now, 85% of benefits could be taxed. And if you are a constrained investor, if you're an overfunded investor, 85% of your Social Security benefits will be taxed based on your income levels and your needs for income there. So there's rental income, there's royalties, pensions, When you do a Roth conversion, the way that that works is that the amount that you're converting from IRA to Roth, which is different than a contributory Roth, I want you to understand that, is that when you convert an IRA account to a Roth account, you are paying income taxes on the amount that you're converting within that tax bracket. So it's really important to understand, where do you fall inside of those marginal tax brackets, and what could you possibly fill up in those brackets to create Roth accounts, right? And then there's capital gains taxes. These taxes vary from 15, 20%, and that could be on the sale of any real estate, non-qualified sales in your brokerage accounts, and then stock purchase from an employer. If you're selling off, investment options, exercising investment options, you're paying capital gains tax on those. So it's important to understand, how are you taxed, and where do the different assets that you have fall into those tax buckets. Income taxes. So let's talk about what's changing. With regards to income taxes and what's changing there, there's going to be deductions that are changing. In 2023, the standard deduction increases to $13,850 for single filers, $20,800 for head of household filers, and then $27,700 for married couples filing jointly. So you get a higher standard deduction, and this is because of the Inflation Reduction Act that's been in place. Tax brackets. So what's going on with your tax brackets next year? 7 tax brackets are going to remain the same. They're not changing the rates, the different percentages in the 2023 year. Instead, the IRS is just adjusting the income values in each bracket to give filers more breathing room amid high inflation. So let's take a look at what that is. So you can see on the left-hand side, those are our 2022 tax rates. You can see that if you're looking at 2023 rates, individual income, married couples filing jointly, you get a little bit more of a buffer there, especially for married couples filing jointly. You're a few $1,000s difference between your 12%, your 22%. This could help you actually convert a few or more thousands of dollars in Roth money at a 12% rate, instead of being automatically at a 22% rate as a constrained investor or an overfunded investor. So what you want to be looking at inside these brackets is how your income tax for this year fills up the 2022 rate. And then if you're thinking about the same income for next year, if things are pretty predictable for you in that cash flow, then you can look at your 2023 taxes and estimate roughly what you also can convert now into Roth. So this is very helpful when we're doing Roth conversions, to look at these. Shouldn't you have, I get this all the time in workshops that we teach, shouldn't I have reduced taxes in retirement? Not typically. You get more income than you expect in retirement. That comes from pensions, RMDs, Social Security, dividends, those types of income sources. People normally don't think that they're going to get taxed on Social Security benefits. They actually are at the federal income tax rate. And then you don't want to reduce your lifestyle, obviously, because you're getting taxed so much on these different income amounts. And so you want to look at, how do I have a more strategic approach to this? Less deduction opportunities is another thing that people encounter. There's a 401k that you used to get deductions on. You stop receiving those deductions when you retire, and you roll that 401k over to an IRA. HSA contributions, mortgage interest, donations. You might have less donations in retirement as well. So if you're thinking about, where you fall in this category of underfunded, constrained, and overfunded, when you're in any of one of these, it's you're going to hit more taxes than you thought you would, because you lose these deductions that are pretty invaluable. So here's 4 strategies that we're going to teach you today to reduce your income tax. The number 1 strategy, Roth conversions. You have to ask yourself, this is the right question to be asking yourself, how much of your total assets are pre-tax? All retirement accounts are tax deferred. That's your 401k, your IRA, all those accounts listed there. If we assume taxes are going to go up in the future, it might be beneficial to pay those income taxes now to secure yourself tax-free benefits later. Every dollar your pre-tax account grows, you're paying income tax on that growth as well, not just the income that you receive, but whatever whenever you're growing assets there, you're going to have to pay income tax on the growth. Roth money is after tax dollars, and it's tax-free growth after 5 years. So converting to a Roth can be pretty beneficial when you have a sizable amount in an IRA, $1 million, $2 million sitting in an IRA account. That's a lot of money that you're going to have to be paying taxes on over the course of retirement. And the course of your retirement paying taxes is actually more significant in most cases than doing a Roth conversion and having to pay that income tax up front to convert on that amount. Here's a simple example for you before tax increase. So current account values at $500,000. The tax bill year starting at 67 is $4,400. Let's say that's the year that they're withdrawing out money to supplement from their Social Security. And then times this by 30 years. So 4,400 times 30 is $132,000. So over the course of that person's retirement, they're going to pay $132,000. That's a good chunk of the IRA that's actually going to go to taxes. If you pay off taxes over 4 years, at let's say $100,000, you can have $400,000 of after-tax money. And that's going to give you actually a tax savings of $32,000. So it's based on where you're at in your income tax brackets that you can convert this amount, but that's a sizable amount of savings. Instead of paying $132,000, you pay $32,000. Big difference, right? We'd want to do this. Do you have different kinds of accounts that we can prioritize withdrawals from? When you're looking at IRA accounts and brokerage accounts, and you're looking at annuities and different sources of retirement income, you have to prioritize and be very careful what places you're withdrawing from in any given month in your retirement. The goal is to have different kinds of accounts that you can pull from. It's just like your diversified investments. You want to have diversification in your taxes and your taxable accounts. So you have pre-tax, taxable, Roth, and tax-free. So it's much better. I'm going to show you an example in a minute how you can structure withdrawals to help you minimize your taxes. But you want to have some money in these 4 different buckets that are going to help you. And ask yourself, how many of these accounts do you actually have? Most people that we work with have a lot in the pre-tax and taxable accounts. Very little's in Roth or tax-free. Congress is going to raise taxes either on income tax or capital gains tax. So we want a strategy with both available so we eliminate having all of our eggs in one basket. And this is how you want to put together a structured withdrawal plan for yourself, using pre-tax money first so we can pay income taxes at the rates when they're at the lowest, right? As of right now, it's the lowest tax rates we've seen. So what you want to do is use that pre-tax money first, and then taxable accounts next. So capital gains tax is less than income tax. In the years when it's maturing, we do some tax loss harvesting. So, we have losses and gains in the portfolio so that we can reduce the overall capital gains bill. And then after-tax accounts, lastly, when we know taxes will be the highest and gives it more time to grow tax-free. So look at this example, creating diverse income strategies. Okay, let's say we have an investor with an income goal of $7,000 per month. If 100% pre-tax income, right, the tax bill is going to be $18,480 per year in retirement. Instead, we can create income from capital gains and tax-free resources, right? So $3,000, let's take $3,000 per month pre-tax income. That's 12%, $4,320. And then $2,000 per month capital gains income, 15%. That's $3,600 for the year. And then $2,000 a month from the tax-free bucket, and that's $0 in taxes that we're paying. So instead of paying an $18,480 tax bill, we're paying $7,920. So that's a arguably better strategy. Wouldn't you want to actually incorporate this into your planning, right? So let's talk about capital gains taxes. Capital gains tax rates, are they changing for 2023? There are tax inflation adjustments to those. So you can see that we're getting a little bit better of a cushion on 15% and 20% rates for joint filers and single filers and head of household. I'll leave that on the screen so you can take a screenshot of it if you want to. Another component to building a tax efficient plan is incorporating cash value life insurance, where you might be able to pay some taxes up front on some accounts that you transfer into life insurance. And a life insurance contract is it's different. It comes in all different kinds. You can have term, whole, universal, or IUL, index universal life. And what you want to be working with in terms of your retirement, you don't want the term insurance necessarily. What you want to do is try to convert that into a cash value policy where you have a cash account, a death benefit, and a long-term care benefit, where you can get access to these different accounts. And when you use an index universal life policy, that's the policy we work with the most at Paradigm. That actually allows you to grow your cash account value tax-free using indexes. So like the S&P 500 or the Citi Grand Master Index or a Merrill Lynch RPM Index or Barclays, or they have all these different types of indices out there that have performing consistently well and are used for index contracts with life insurance. And so your cash can grow tax-free, your death benefits tax-free, your long-term care can actually be generated from the death benefit if you go through a terminal illness or critical illness, or you're in a critical care facility and you have this kind of diagnosis come out, then you can start withdrawing from the death benefit tax-free to pay those costs. And those costs could be $8,000 a month in some circumstances. So that's life insurance. It's a great tool to be using in a tax plan. Number 5, there's non-qualified investment preferences, right? You think about what investment vehicles you have in your non-qualified accounts, and it's very important to understand that. Some people have actively managed accounts that are inside of this that are traded probably way too much and are exceeding the capital gains tax exposure that the investor really wants. And so you want to be careful about what investment vehicles, again, you're putting in there, because there's some things that are outside of the control that you might have, such as mutual funds, preferred stock, REITs that pass off a K1 to the client. So you want to be careful about these types of accounts inside of a brokerage account, because there is trading happening inside of these that could result in capital gains taxes. And all those investment types create income taxes by spinning off dividends, income, or interest in some cases. So you cannot control when these spin-off activities occur, right? And so you'll be left with an unexpected tax bill that you can't really do anything about. So it's really it's wise to consider less volatile, less traded accounts inside of less traded investments inside of non-qualified brokerage accounts like ETFs, or you want to have a lower a more actively managed account. If you're going to do that, you want to have a more value-based ETF that you want to put inside of that, so you're not encountering all these different types of trades that actually happen inside mutual funds that can actually cost you money. The advisor actually has no control over the buying and selling that a mutual fund does with its own managers. So, for instance, a couple of investors have walked through our door this year with bond funds, and every time the bond fund sells a bond off for these newer bonds that are coming out with these higher interest rates, that's creating a tax problem inside that account for that client. So, and it creates a loss in the portfolio, right? So you want to be careful about what if you own a mutual fund or a bond fund, you want to be on top of what's going on inside this fund. What are they doing? Are they buying? What are they buying? What are they selling? You want to be able to keep your eye on that. So number 6, there's charitable remainder trusts. And these are, we refer to them as CRTs. A charitable remainder trust can be set up, and it's an irrevocable trust that you set up with a charity as beneficiary, and you can put assets with high capital gains inside this trust and receive a tax deduction for doing so. And you can sell the assets off to buy annuity units or life insurance that can possibly give you tax-free income in retirement. And bringing back that tax deduction, right? Which also allows you to convert on Roth conversions if you're able to do this. It's a pretty great strategy. If you want more information about it, shoot me an email after this. We've got some great white papers we can show you about CRTs. There's no capital gains taxes on the sales that happen inside of a CRT. That's pretty great. So 10 to 20% of total assets goes to charity at death. That's one bylaw that you have to follow when it comes to a CRT. You must give 10 to 20% of total assets goes to charity at death. But this is a great move for people who are probably on the constrained or overfunded spectrum of retiree, and they want to eliminate some of these capital gains taxes on maybe property, on maybe a employee stock option plan, and they want to start selling off some of these things, but the taxes are going to be pretty high. And so one thing that you can do on some of those is you can actually transfer the ownership of that ESO to the CRT and set up the guidelines to where you can actually sell off those options and actually receive no capital gains on that sale. So if you want a strategy session on this, we're happy to do that. We're doing 2 or 3 of them actually in the month of December, and it's really exciting for these families to be able to use this strategy. So what can you do now with 2022 taxes? Is it mathematically in your best interest to convert a portion of your IRA into Roth? I think that's a pretty good question to be asking right now. If you don't know the answer to that, that's the reason why you want to schedule a tax analysis with Abby and myself to help you think that through. Make sure that you've made charitable contributions for the year. Remember to take your RMDs for this year. The penalty on RMDs is 50%. If you do not take those, just make sure that you do. You want to invest in tax-free or tax-efficient assets to diversify your income and tax factors. Remember, going back to income taxes and capital gains taxes and tax-free, where do you want to be in that side of the spectrum come 2025? Hopefully, you'd want to be more on the side of the tax-free fence instead of working in that account. But you also want to consider the investment vehicles that you're putting inside of these brokerage accounts that you have. What are you doing to eliminate taxes later in retirement? i.e., long-term care needs, right? So you want to be thinking about survivorship. Lastly, so taxes are going to affect survivorship. This is something I'll leave you with. Most couples don't understand this, and that's that right now you're filing as married jointly, and you're receiving a pretty great tax bracket by doing that instead of single. And you have to ask yourself, this is probably another one of those right questions that you should be asking. How would your partner's death increase your tax bill? For example, if your income is $7,000 per month and you pay $10,080 in taxes, right? As a married filing jointly, if you took that same income amount and applied it to a single taxpayer bracket, you would be paying $18,480. This could change your annual income by $8,000. That's a lot of money. So do a survivorship plan, figure out, get a tax analysis in place, right? Follow, and we have a process for this. So you have to have the right process, right, to go through the steps in place to make a decision. You want to have those right questions. We've given some of those to you in the webinar today. There's absolutely more questions when it comes to your retirement planning and investment management, and going through a fiduciary process, right, to help you manage your investments better. And then you want to have the right checklist involved. What are the things that you just need to take care of if you're going to make some of these tax moves? And you apply those 3 to the critical facts that you've learned today, and hopefully that will help you make a sound planning decision about your retirement and your finances. So what's next? So you can schedule a 60-minute strategy session today. If you're watching this recording, you're probably going to see a link. If you go back to the email that you received, it'll have a little link there for you to click on to check out our calendar for the next couple of weeks. We're available for tax analysis meetings. It's a 2-meeting deal. We don't charge for those. We help you get your questions answered when it comes to Social Security, taxes, your risk management, RMDs. How could you eliminate these taxes? Diversify your accounts. Can you make moves right now? Is there something that we can help you set up and take care of when it comes to your retirement? So this is our office. This is where we're at. We love being here out in Scottsdale, and for the clients that we have in Tulsa, we appreciate you so very much. We love our Tulsa investors. I'm looking forward to go travel out to hopefully another happy hour event or ice cream social with y'all out there. So thank you for being on the phone call today. If you have questions, again, write us an email. Hopefully this webinar has helped you think through some possible strategies you could be using either on your own or with us or elsewhere. So that's where we're at in our offices. Come see us at our Women in Wine events. Check out our event calendar for next year. Go to there's a link to our website. You can check out our events page. We're going to be putting some more events on that page in the next month. So check back there we're going to do some happy hour events. We might do some movie events, might do some more workshops. So stay in touch with us. We do have a Women in Wine event that we're going to host at Spiga on December 16th. It's our current location. That is for women investors who want to mingle, socialize with other paradigm investors that are here with us, and just learn a few tax tips from Abby and then have a good time at that event. So love for you to come join us at that event. I hope you had a great webinar with us today. And we're here at Paradigm helping you build resilient retirements that are built to last. Thanks.